You are listening to Keystone's Stock Talk Show, episode 302. It's great to chat with you. This week, I will kick off the show with a look at an article I authored this week on the tale of two small cap M&A strategies, comparing the successful measured approach of Firan Technology, which has gained over 700+% since our recommendation, versus the aggressive equity diluting strategy of Simply Solventless, or hash, on the TSX venture. Not a recommendation, and which has not gone up 700%. I think it's gone down around 70% this year. In our Your Stock, Our Take segment, Brennan looks at Lakeland Industries, symbol Lake on the NASDAQ, manufactures and sells industrial protective clothing and accessories for the industrial and public protective clothing markets worldwide. We have interviewed Lakeland a few times in the past, not recommended it. The stock has struggled this year. It's down around 50%. Brennan lets you know if it's an opportunity. In our Star and Dog segment, Brett reports on two interesting businesses. The dog, HIMS and Hers Health, symbol HIMS on the NYSE, a retail investor favorite, has dropped just to start this week 31.6%. Brett will let you know why. On the flip side, we are very happy to report our star of the week is a recent Keystone small cap recommendation, Groupe Dynamite, symbol GRD on the TSX. The stock is up over 50% in the past several trading days. After the company reported strong earnings and increased guidance, clients will be updated shortly on our current rating on the stock. To close out the show, Aaron will look at the art of dividend growth stock investing. All right, let's get to the show. I welcome my co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How are you guys doing?
Doing well.
Great.
Good. How are you?
Good to hear. Yeah. Busy week. I got my daughter's birthday this week. So we did birthday bowling this past weekend, which is always fun, getting 6, 8, 12 kids there bowling, throwing pins into the wrong lanes, or actually throwing balls. They probably threw pins too down the lanes, but it was good fun. It's a good time. And now we'll do the family type birthday this week, so that should be good. But
last week of school for the kids, is it not?
It's crazy.
I know in Saskatchewan here it is. Yeah, so.
Ends here Friday or Thursday for us.
Yeah, same here.
How about you, Aaron?
Yes. Wednesday.
Wednesday's
the last day. Yeah.
Cool. One day early. Yeah. No. So we have a beach day,
and it's a half day on Wednesday. So
it's crazy.
Yeah.
Well, it is an interesting week in the markets. Do we want to touch on any of the activity, or do we just want to get to the poll question? Probably get to the poll question.
We can get to the poll question. Since I think everyone's heard about what's going on in the market over the weekend, and by the time this video is actually released, it'll all be different anyways.
It's true.
So the poll question of this week is, do you or have you used leverage to invest? 30% of our viewers said, yes, I currently use leverage to invest. 25% say they have previously used leverage, but not currently. And 45%, the majority, have never used leverage. As well, a couple of comments. Someone saying that they sometimes utilize leverage ETFs, but rarely. And that seems to be the more popular way to go about leverage for retail investors these days, is using leverage ETFs, because they've just exploded in popularity. With then another comment saying they only use URTY, which is a leverage Russell Index ETF, which I do actually have a chart comparing it to the normal, the IWM, which is just a Russell 2000 ETF as well. And we can really see here, this is since the leverage ETF started in 2010. And the returns are effectively identical at this time, despite the significantly, obviously you can see way higher in the blue there. The leverage ETF performed way higher during COVID, but obviously much, much higher volatility. And we've talked about this before, I can't remember, about a year ago or so, the volatility decay of leverage ETFs. And you can really see that in effect here is, even when the market performs okay over a period, but it's relatively flat, these leverage ETFs, they perform worse than a normal unleveraged ETF. But then they do have these big spikes of opportunity because they're really a trader's tool. They're not these long-term investments. And you can see here why. you've taken way more risk. If you needed to liquidate during COVID, you would have well underperformed the normal ETF versus if you were just holding the ETF for the long term. And in this case, somehow it's effectively the same return, which just coincidence more than anything.
Yeah. Absolute luck, basically, right? Yeah, that's what we're seeing there. Yeah, it is interesting. And you did an excellent segment kind of on the leverage ETFs in the past. You'll probably follow that up with another segment.
I'd love to see that because it's an important thing for people to understand when they're considering investing in these types of products. That you think volatility is good, or I buy up at the peak, and then it's a reverse bull ETF or something. So if the price drops, but it's far more complicated than that. So that's why we're always, when it comes, people will say or ask us, what do you think of ETFs? Well, ETFs, they range vastly in terms of like what they are and how risky they are. So if you're talking like a vanilla simple ETF, no debt leverage, no derivatives, just follows like a market, like the S&P 500 or the TSX at like a low cost, that's a good option for some investors. But anything that is more complicated than that with leverage, with derivatives, we wouldn't touch it or advise it.
Yeah, and I think as Brett has pointed out, you can be right on the direction of the markets, and if you're holding them over even a small but a reasonable period of time, you can lose a significant amount of money and be right long term on the direction of where the markets are going. So I mean, that's something I think it isn't talked about enough. All right, should we just get into the show here? All right. So this week, I am going to touch on an article that I authored on basically a tale of two small cap M&A stock strategies, comparing two companies. One would be Firan Technologies, FTG on the TSX, and Simply Solventless or Hash on the TSX Venture, juxtaposing the two. It's a summary here. They juxtapose the responsible acquisition strategy of Firan with the more recent aggressive dilutive approach from Simply Solventless Concentrates, illustrating how their respective paths have impacted shareholder returns. And we have interviewed both of these management teams once for Hash about 20, 25 times for Firan. One we have recommended and owned for about a decade. The other we took a hard pass on. This will be part one. I'm going to look at more Firan today. Give some general thoughts to start on the small and microcap M&A strategies that we see in the market, aggressive versus measured. Businesses that use M&A as their primary growth driver, we believe, walk a fine line. For every massive success story like the Boyd Group's, a serial acquirer of auto body repair shops recommended by KeyStone in 2008 at $2.30, it trades above $200. So a success story. There are 10, say, Dye & Durham's or Lightspeeds, decent businesses that execute poorly on aggressive growth by acquisition strategies. There are also countless roll-up stories that never even get out of the starting gate and end up destroying investor capital. Unfortunately, the microcap market is littered with failed or failing M&A strategies, including a recent example that we will have in part two and touch on that next week is Simply Solventless Concentrates. The company provides an excellent foil for the more measured and successful M&A strategy of Firan Technology Corporation, FTG on the TSX. So the strategy of growth by acquisition can be a powerful accelerant for a company's expansion, but its success hinges critically on execution and financial prudence. While an aggressive debt-funded or fueled and highly dilutive approach can lead to rapid scale, it often comes with significant integration challenges and shareholder value destruction. Conversely, a measured, responsible strategy, often characterized by strategic debt utilization, minimal shareholder dilution, tends to yield more sustainable and rewarding long-term gains. Let's look at growth by acquisition in reality. While sexy in theory, growth by acquisition can be a risky strategy with many high-profile examples of mergers and acquisitions failing, often spectacularly. The reality is a significant number of acquisitions fail to meet expectations, with estimates ranging between 70 and 90%. That is quite a shocking figure, but it is from studies that show that most acquisitions don't even meet the initial expectations. Common reasons for failures include poor integration, overpaying for the target company, overestimated synergies, we see that a lot, cultural clashes, and a lack of strategic alignment. Now, what is KeyStone's preferred growth strategy? We look for a mix of measured M&A funded by cash flow, cash on hand, or reasonable debt, always with an eye towards continued organic growth within the company's existing operations. That is the most profitable growth for these businesses. As an example from KeyStone's small cap Canadian research of an effective M&A strategy, we enter Firan Technology Corporation's FTG on the TSX. The business of this company, a North American manufacturer of high technology printed circuit boards and illuminated cockpit products for aerospace and defense. Its M&A strategy has been disciplined and accretive growth by acquisition model. FTG has pursued an opportunistic and measured M&A strategy to expand its capabilities, customer base, and market reach, all while maintaining a strong balance sheet, that's important, and prioritizing shareholder value through minimal equity dilution. So let's say FTG's approach often involves looking for strategic fits, acquiring companies that complement existing operations, technology, or market segments. They look for reasonable debt levels, cash on hand. They maintain that while making these acquisitions. It avoids diluting existing shareholders by issuing new shares. Effective integration. They are focused on integrating and acquiring businesses to realize synergies and optimize operations with an eye to growing those businesses that they acquire organically. Let's look at their timeline, their M&A strategy over the last 10 years. We go back to 2016 to start this off. Photo Etch was a company they acquired there. They acquired it to expand the customer base and product offerings. They successfully transitioned operations into an existing facility, closing the Photo Etch site. So they bought their customers. Teledyne, PCT, similar to the Photo Etch, this acquisition aimed to expand product lines with operations moving into FTG's Chatsworth facility. Now, in 2022, 2023, following the global shutdown of travel and the pandemic, huge hit to aerospace, the business responsibly played defense, built a strong net cash position, and just ahead of loosening of global restrictions, the company played offense, buying two businesses primarily with cash on hand. Those two businesses here, IMI Inc. and Holiday Circuits, was the big acquisition, added U.S. manufacturing capacity for RF and high technology products for aerospace and defense. Combined sales of these two businesses, primarily the sales came from Holiday, pre-pandemic were about $45 million. So sizable acquisitions. In Q1 of this year, the company completed on Flight Aerospace a significant acquisition, enhancing FTG's presence in the commercial aerospace aftermarket and expanding product offerings, particularly on Airbus aircraft. The deal reinforces FTG's commitment to strategic accretive growth in its core segments. Through these acquisitions, FTG has demonstrated a commitment to managing its debt effectively. For example, in Q1 2025 results, even after all these acquisitions, the Flight acquisitions, which just came in, FTG reported a healthy net debt of only $8.3 million. The company's consistent generation of strong operating cash flow has been instrumental in its ability to take on debt for strategic growth and then deleverage. Let's look at their minimal shareholder dilution over time. A hallmark of FTG's responsible growth strategy is its commitment to limiting shareholder dilution. Over the past decade, despite multiple acquisitions we saw there, the company has largely avoided significant share issuances to fund these deals. So the weighted average number of shares when it started this deals, Photo Etch and Teledyne, 2026, about 24 million shares. Post-acquisition, about 24.9. That's post the Flight acquisition. This represents an increase of less than 4% of shares outstanding over nearly a decade of significant growth, multiple acquisitions, demonstrating remarkable financial discipline and a strong focus on enhancing per share value. It's not surprising over that period. This is even just over the past 5 years. But since our recommendation at about $1.35, the stock is up well over 700%. But you can just see it's up just under 600% in the past 5 years. Next week, I'm going to touch on the foil for Firan Technologies. That would be Simply Solventless hash. So stay tuned for that. There's our disclosures.
I hate to say it, but I think I'm looking more forward to next week. I mean, obviously, I'm familiar with Firan, and it's been a tremendous success story, but I'm looking forward to you ripping on Simply Solventless.
Yeah, and it's not necessarily just ripping on the company. It's just showing one strategy versus the other strategy and which is more successful over the short and long term. And, proof is in the results. That's what we always say. With Firan Technology, basic, boring business, but those results to me are sexy. Hash may have been a sexy business, but we'll see, the results have not been sexy.
Ryan just likes cash.
I also like saying sexy a lot, apparently.
A little greedy that way, but
yeah, it's true.
Good in this line.
Cash or hash? I'm not sure. As long as you said hash, that would be different.
Yeah, it's legal.
Yeah, it's true.
I said cash, but you're allowed to like hash as well.
It's true. It's true.
Just not the stock.
No. I mean, and again, nothing against the business. It's just the execution in terms of the acquisition strategy. Very aggressive, short term, and we'll talk about that next week. All right. Unless anybody wants to talk more hash. No. FTG. No. Well, let's move on. Let's look at Lakeland. Lake on the NASDAQ. Brennan is going to handle a Your Stock Our segment. Take segment. What is it called? Nobody.
You got it. You got it. So this question comes in from Oliver, again on Lakeland Industries, LAKE on the NASDAQ, currently trading at a price of about $13.45. I think it actually closed today at $14. Market cap of about 122 million and a dividend yield of just under 1% at 0.94%. So they manufacture and sell industrial protective clothing and accessories for the industrial and public protective clothing market worldwide. It offers firefighting and heat protective apparel, high-end chemical protective suits, and limited use disposable protective clothing, as well as high visibility clothing as well. The company targets a mid-single-digit organic growth rate across the business and also makes acquisitions with 5 over the past 3 years, trying to roll up the fragmented global fire market now with a head-to-toe product offering. We have interviewed management a few times now, the most recent being in April of 2025 at the Planet Microcap conference in Vegas, but the stock has really been struggling this year so far, down 50% year to date. And this has really been led by Trump's Liberation Day tariffs, as the company either leases or owns manufacturing facilities in the US, but also in China, Mexico, Argentina, India, Vietnam, Romania, and New Zealand. And management noted back in April that they had built up inventory with about 10 to 12 months of runway before a major impact. They also moved some production into the US, as well as shifted critical component sourcing from China to Vietnam, and that they expect to increase prices of its products to offset potential margin impacts as well. So they are trying to mitigate the effects of tariffs. Now, looking at the financial results for Q1 of 2026 ended April 30th of 2025, revenue was up 29% to $46.7 million. And this was led by growth in its fire services product line due to the acquisition of Veridian, acquired in December 2024, and LHD, acquired in July of 2024. Gross profit margin was 33.5% compared to 44.6% for the same period last year. And the lower gross margin is due to revenue mix coupled with lower margins in its acquired businesses due to amortization of the write-up in inventory, as well as higher manufacturing and freight costs. The company posted an operating loss of $4.6 million due to a significant increase in operating expenses attributable to the acquisitions of Viridian and LHD, and net loss was $3.9 million, or a loss of 41 cents per share, compared to a gain of $1.7 million or 22 cents per share in Q1 of 2025. And the company posted adjusted EBITDA, excluding FX changes, of just $600,000, down from about $3.8 million for the same period last year. So, margin wise, it was a bit of a tougher quarter, but top line growth was still strong, driven by the acquisitions. Now, the balance sheet remains relatively healthy with net debt of $21.6 million, providing a forward net debt to EBITDA multiple of just 0.8 times. And the company has also been pretty good at reducing its share count over the years, but they did issue 1.8 million shares back in January of 2025 at a price of $23 per share, which now places the company at approximately 9.5 million shares outstanding. So obviously, moving forward, it will be interesting to watch to see if they use their shares as currency more, especially as they are this roll-up growth strategy. So that is something to keep an eye on. Now, looking toward fiscal year 2026, management provided guidance, and they expect revenue of $210 to $220 million, which represents growth of approximately 29% over fiscal year 2025. And this includes the Viridian acquisition. And adjusted EBITDA is now expected to be in the lower end of its $24 to $29 million range due to tariffs, but at the midpoint represents growth of approximately 52% over fiscal year 2025. And looking at the valuation, this places the company at approximately 5.3 times forward adjusted EBITDA, but its trailing valuations are all negative, such as its price to cash flow or price to earnings multiple, just because cash flow and earnings have been negative over the last 12 trailing months. So to conclude here, Lakeland is an intriguing recessionary resistant business. It's not recession proof, but it's recessionary resistant with mid-single digit organic growth, while it plans to continue rolling up the fire market with up to 2 acquisitions a year. So we definitely see it having some good runway in that space. Now, the business is currently facing some tariff headwinds, but management has put in place plans to mitigate tariffs and continues to guide fiscal year 2026 revenue and adjusted EBITDA growth of 29% and 52% respectively. Again, partially driven by those acquisitions that it has made. The company does pay a dividend, but management noted that they would prefer that they didn't have it and do not expect to grow it. That is one thing that kind of attracts me to a business like this, is the dividend. It's kind of a boring business. But if they could grow that dividend over time, I think that would be quite intriguing. But I understand management's strategy where, again, they are this roll-up strategy. They want to continue to use their capital for acquisitions and, create shareholder value that way rather than just, returning capital to shareholders through the dividend. So I understand the strategy, but I do think that it would be interesting if they, wanted to grow that over time. And, just overall, growth does remain good this year. The business appears cheap on forward adjusted EBITDA, but tariffs remain a risk. Q1 2026 was weaker, but there should be sequential improvement in margins as the year goes on, which we will continue to monitor going forward. And here is the disclosure.
I remember interviewing this company in Vegas with you guys about a year ago, and we had looked at it. We'd been following it for almost a year at that point, and it just really seemed like a very simple kind of what could go wrong with this business, right? I mean, it had good profitability. It seemed to be selling into what would you'd consider to be an essential industry, right? But now maybe there could be something to follow in terms of just valuation wise if they can get back up to that level of earnings. But I certainly wasn't expecting this type of volatility in the performance. Of course, they weren't expecting Trump's tariffs either. So a year ago,
for sure.
But yeah, I agree. Or go on, Ryan.
Yeah, I was gonna say, I guess the with Lakeland, they want to be creative, they want to grow that way, roll up its segment. I think the rubber is going to hit the road. It's been a good, disciplined, long-term company, not issuing a ton of shares.
Yep.
Now they're in a net debt position, so they're starting to issue shares. It was done at higher price earlier this year, so it's more easy to be accretive. But now in a net debt position, lower share price, it's more difficult to make accretive acquisitions on a per share basis. So, I mean, we've seen companies get into that situation where they can't get a multiple for their shares. And then, you don't want to issue shares because then it's not accretive on a per share basis. And it's a vicious cycle. So again, like what I was talking about earlier is the patient approach is typically better than if you can't make those acquisitions, they're not smartly accretive, generate cash flow, pay down some debt, and then either do it when you can or do it slower. It's just, we see so many companies so desperate for the next quarter. Matt, there's analysts out there. They're always, oh, are you growing? Why aren't you growing? Well, if you grow irresponsibly, it's far worse in the long term than just growing for the sake of revenue and not on an accretive basis in terms of per share cash flow will not drive your share price higher long term. So, I mean, this hopefully Lakeland, takes that advice basically and grow at a measured pace. If you can do it accretively, 2 acquisitions a year, fine. If you can't, either you go too much into debt or you can't issue shares, just pay down debt, then make your acquisitions over time. That would be the way to do it. I mean, we just saw Firan, a boring business, do that. And, those are I'm sure Lakeland would love to produce 700+% growth over the next decade. So there's your path, measured and disciplined, and make sure you keep that share count lower. All right. Do we want to move to the next segment?
Move to the next.
Brett, you've got our star and dog. I think you're going to do the dog first, but we are excited to look at your star because it is a company that we just at the start of this year introduced into coverage. So Canadian retailer at a time where many retail stocks are getting kicked hard, and this company had really, really strong results that came out and upped their guidance kind of in terms of same store sales for the year. And that stock that you're going to talk about is up about 50% versus HIMS, which had a big drop today.
Yeah, like Ryan was saying, our dog of the week is Hims & Hers Health, HIMS on the New York Stock Exchange, HIMS. So the company operates a telehealth platform that connects consumers to licensed professionals. The company offers a curated range of prescriptions and non-prescription products on a subscription basis with a focus on personalized healthcare. That will come into factor in a minute. HIMS has really been a retail favorite, the stock, and I've seen it everywhere online, effectively any stock board. You've seen HIMS likely, and it's really just generally had a good return over the past few years. But it's been coupled, obviously, with a high degree of volatility during that time as well. But today, it fell 31.6% at the time recording to $43.92. Clearly, a massive pullback, even for a generally volatile stock. So, why did the pullback occur? So that's due to Novo Nordisk, symbol NVO on the New York Stock Exchange as well. The creator of the GLP-1 drug Wegovy abruptly ended its agreement to provide the weight loss drug to HIMS. The deal allowed HIMS to sell Wegovy branded drugs on its telehealth platform. The deal was struck just this April, so only a couple months ago, not long after the GLP-1 drug was removed from the drug shortage list by the FDA, which removed HIMS and others' ability for generic compounders to produce the semaglutide, which is what Wegovy is. So Novo Nordisk ended the agreement due to concerns about knockoff versions of its drug. The release claims, at least, HIMS has failed to adhere to the law which prohibits the mass sales of compounded drugs under the false guise of personalization, putting the patient's safety at risk. Further, the company is concerned about counterfeit drugs being manufactured in unauthorized foreign suppliers in China. So there's that personalized coming in. That's really has been a big selling point of HIMS is this personalized treatment on a telehealth platform. And that's something which is being directly really attacked here from Novo Nordisk, at least in their concerns. So the degree of pullback is really due to that fact that GLP-1 craze has just been a major boon for HIMS. The company has been using the popular weight loss stock as a growth driver for its other products as well, as HIMS can cross-sell its other products to the weight loss subscribers, increasing the revenue generated on a per subscriber basis. So if you go on the HIMS platform to get the weight loss drug, you might buy some of their other products. That's all it is, really. And that's really what they've been marketing as well. They actually had a Super Bowl ad directly targeting obesity in the US, and had actually controversy around that specific ad. But it is something that they have really had a marketing push because it's been such a key product on their platform. And it actually ironically promoted in this ad, which I have up a screenshot of it, that is formulated in the US, which if those concerns are true, that's obviously not the case anymore, but we'll see how that comes out. Overall, the affordable weight loss drug has really been the biggest selling point to consumers and really was propped up the stock over the past couple of years. So just as an example, in the last quarter, the average revenue per user grew by $29 to $84 year over year, which the company actually directly attributed to subscriber uptake of its GLP-1 offering, alongside product mix as well, though. So GLP-1 really, it's just been the driver of the company as a whole. HIMS CEO just very recently, during this recording, issued a statement on the contracts end and saying they refuse to be strong-armed by any pharmaceutical companies' anti-competitive demand that infringe on the independent decision-making of its providers and limited patients' choice. So obviously they're pushing back. They clearly don't agree. That's no surprise to anyone, but the agreement is gone. So even if the allegations are true, the agreement is gone, and that will hurt HIMS regardless. And regardless of really what the outcome is of here, is HIMS is our dog of the week, and it is had a tough day. I don't know if you guys had any comments on that, or if you want me to go straight into our star.
I guess straight into the star. We just can't wait for you to get to Groupe Dynamite. Waiting with bated breath.
Yes. I won't let Ryan wait any longer. Our star of the week is Groupe Dynamite, symbol GRGD on the TSX. It's a company we do have in coverage, obviously very recently, because it only IPO'd actually last November. And it hasn't been, up until recently, the greatest time for the stock. As you can see here on the chart, Liberation Day was obviously a big hit. As well, we'll get into why the industry as a whole really hasn't been happy in general. But if you don't know, Groupe Dynamite is a growing women's fashion retailer. The company caters to the needs of Gen Z and millennials through its brands Garage and Dynamite. The company operates 297 stores across Canada and the US, as well as online. The split between Canada and US is about 50-50. The company, even though it just IPO'd recently, was actually founded in 1975. And then it IPO'd, just like I said, in November of last year. The stock has skyrocketed, though, since 44% since reporting its fiscal Q1 earnings on June 17th, and is now trading at $23.82 a share. And just for our own client purpose, and just to really pump up what we're doing, we recommended this stock back in February at a price of $16.11. So obviously great returns for our clients, and we were really pushing into, when it did dip after Liberation Days, that our thesis was still intact. So why did the stock actually surge on earnings? First off, we need to recognize the environment not just Groupe Dynamite has been, but the whole apparel industry and really retail, anything consumer discretionary has been at this time. The industry is just exposed to U.S. tariffs more than other industries, and it's just generally weathering poor consumer sentiment. It hasn't completely appeared in consumer spending. You still have slight uptick in consumer spending, but the sentiment is really at an all-time low. And this has really been appearing as well in earnings. So, for example, Aaron highlighted last week, Lululemon's cut to guidance, which resulted in a significant decline in the stock. And that's the direct opposite of what we're seeing here with Groupe Dynamite. But generally, retail and apparel companies have just not had a great macroeconomic environment to operate in, which is why we saw the Groupe Dynamite falling, the stock that is, at the beginning of the year, then sharply on that tariff announcement. It was alongside with the rest of the industry. The entire industry really fell alongside with it. But with the Q1 earnings, we can see that the underlying fundamentals remain strong for the company. Revenue up 20% to $226.7 million. Same store sales growth up 13%. Operating income growth up 16.2% to $44.3 million. Adjusted EPS up 8.7% to 25 cents a share from 23 cents in the prior year. As well, a non-financial metric, which I'd like to highlight, a reduction of by more than 50% of China receipts into the US as a response to tariffs, which was a major concern, not just for Groupe Dynamite, but as a whole, but specifically for Groupe Dynamite, because they did have around 70% of their inventory being sourced from China. So obviously with tariffs shooting up to 140% at one point, that is a major concern, but they've actually pivoted quite well out of China, as well as tariffs have pulled back a bit since then. Further, the company has even an improved outlook as it raised its same-store sales growth guidance to the range of 7.5% to 9%, and that was from 5 to 6.5%, while holding the EBITDA margin range of 30.3 to 32.3%, which shows that the continued expectation of momentum for the rest of the year, as they are actually raising their guidance, they're expecting better results, unlike what you saw with Lululemon, the exact opposite, where they cut guidance. You're seeing actually improved guidance, which is really an anomaly in this market. So generally, if as a whole, a great quarter with improved outlook in a broadly just poor environment caused a quick snap to the upside for the stock and has been obviously a great return. And for our clients, we will be updating the company in full in the near future. But for now, it is our star of the week.
Yeah, and I think that snap kind of the expectations of weaker results for the sector overall, and then you juxtapose that with results that were actually better than expected, and then the outlook is actually upticked for the year, and that's how you get the recipe for a stock having a significant jump in a short period of time. So nice to see. Worries earlier this year, but I mean, the company has been delivering, and if companies deliver over the long term, I mean, there is worries of a weaker Canadian and U.S. consumer heading into the second half of this year, but that guidance still is lower same store sales than they saw over the last couple of quarters, so they are baking some of that in. We'll see if they continue to deliver again. When we come out with that buy on Groupe Dynamite, that was not for what they're doing over the next 3 to 6 months. It's doing for 3 to 5 years. And, it's similar to a recommendation we made about 5-6 years ago in Aritzia. Stock traded at $16 and it's around 67 today. It has not done this. It has not gone in a straight line to 67. It's done this over time. We would expect there's always challenges. It's a volatile industry, retail, but there are a lot of good things we're seeing from Groupe Dynamite. The balance sheet is relatively strong in the sector, and there could be a dividend introduced in this company over the next couple of years. So that's something we may like to see if there is excess cash, and it looks like they could be heading in that direction. But always like to see that organic growth, and the company certainly has organic growth in tough times.
Well, yeah, and again, like Ryan said, we're looking to hold this company long term. We like the growth. It's a great organic growth story. And when all of a sudden it's pulling back, we're telling clients that they can buy more. Just because again, we're seeing looking 3 to 5 years out where this business will be. Well, we liked it at $16. We like it more at 11. So that was very nice, is we were able to get clients to add to their positions in that range.
Yeah, I mean, this is just an aside, but sometimes we'll have clients or investors who follow our research. If a stock goes up too fast, it's like, well, I didn't have time to get in. And then with Groupe Dynamite, oh, it went lower and I'm panicking. It's like, well, this again, both of those businesses we're looking at, any business is 3 to 5 years out. So if it's a business, as long as the fundamental situation hasn't broken down, and like the fundamentals in the short term were kicked in the groin by Liberation Day, and that caused uncertainty, and there is certainly a reason why, and we understand why the shares went down in the short term. But the fundamental drivers of the business that were likely going to be there over the long term were still in place. So and it's still traded at relatively reasonable valuations. I think it has pivoted even faster than most investors would have thought they could with their supply chain, which is great to see. We'll see how resilient they can be with a weaker consumer, but the numbers are good, and the fundamentals of a business, I like to say, are like gravity, and you can see the gravity was here and it sucked out to that as those results came out. Or maybe it's like a magnet more than anything.
Yeah,
gravity was. All right. Well, I think that closes off that star and dog. Let's get to Mr. Aaron Dunn. Something he definitely knows about. He'll look at the art of dividend growth stock investing to close out the show this week. The closer.
Perfect. Okay. Thank you, Ron. Yes, I do know a thing or two about dividend stocks, as I've been covering dividend stocks through our KeyStone's income research for about 16 years here. So it's been a while, close to anyway. So 15 years, roughly around there. I'm aging myself, so I'm just going to stop talking and get into the content. But yeah, dividend stocks, specifically dividend growth stocks, have been what we have advised clients to make a important part of their overall investment strategy long term. And there's various reasons why we suggest this. I'm going to get into a couple of them in the upcoming slides. Now, a dividend, of course, is a payment made by a company to its investors. Usually this is on a regular basis, like monthly or quarterly. And when I say a dividend growth stock, what I'm referring to is a company that is also growing its earnings, growing its cash flow over time. So it has the ability to increase its dividend on a regular basis. And that's really where the majority of the focus that we put on income stocks is which is in the dividend growth space. So historically, and we've had slides in previous presentations that we've done, historically, dividend growth stocks have outperformed other categories of stocks by a wide margin. And they've done this over time, over a 30-year time horizon with a lower overall level of risk. So this compared to, say, a non-dividend stocks, if you're averaging the groups, dividend growers or dividend payers versus non-dividend payers. Now, there was in terms of interest rates, as we all know, around 2022, we saw what began, what eventually became almost a historic rapid increase in rates. Rates that were near zero were raised between March of 2022 and July of 2023, from about near zero to a peak of about 5%. Now, generally speaking, dividend stocks are inversely correlated with interest rates, meaning that as interest rates go up, they look less attractive to investors. A lot of investors who are looking for income will pull money out of dividend stocks and they'll put it into fixed income like GIC and bonds. So during this period, a lot of dividend stocks, particularly those that did not have a very strong growth profile in the underlying business, have struggled. Now, traditionally, when we're talking about these defensive dividend industries, we'd be talking about utilities, pipelines, energy infrastructure, real estate investment trusts, those types of industries. Now, rates peaked last year in 2024 and have come down since then fairly significantly, after peaking at 5%, down to about 2.75% today. Now, this has really kind of opened up the opportunity for dividend stocks and dividend growers to shine again. But I want to talk about some of the reasons why people should consider dividend stocks as an important part of their overall investment strategy. And what I'm going to do is I want to focus on two key benefits of dividend growth over fixed income, or dividend payers over fixed income. And these two benefits are going to be the preferential tax treatment and also the power of compound dividend growth. So preferential tax treatment, what do I mean by this? Well, when you're getting paid a dividend that is considered an eligible dividend, you get what's called a dividend tax credit. And what this does is this lowers the rate of tax that you pay on those dividend distributions. Now, this assumes that the asset is held in a non-registered account, so not an RSP, not a TFSA, just a fully taxable account. But the impact can actually be quite substantial. So just as an example, if you take a GIC, which is paying around 3% right now, you can compare that to a 5% yielding stock. 5% is a fairly, 4.5%, 5% is a fairly standard yield in terms of there are a lot of opportunities in the market at that level. Now, obviously, the income yield of the dividend stock on a pre-tax basis is significantly higher here. Some people would say, well, you're also taking on more risk with investing in a dividend stock over a fixed income, which is true. But when we actually apply the dividend tax credit and we compare that to the taxes that are applied on fixed income interest, which is just taxed at the full rate, we see a major differential in the after-tax return. So the difference between the 3% and the 5%, the GIC and the dividend pre-tax, is about 65%. 5% being 65% higher than 3%. But when we consider the tax benefit of the dividend here, and of course, this is just the model, it will change depending on what your personal tax rate is, we see a much larger difference. So the GIC on an after-tax basis is paying far less than the dividend on an after-tax basis. It's roughly around half. So taxation-wise, there are advantages in investing in dividends over GICs. But what I think is actually more compelling in terms of the argument for dividend growth stocks is that compound income growth. So let's just do a comparison here. You could say buy a GIC. You cannot buy one now for 5%. But if we go back to the peak, GICs were paying about 5%. So you could have bought a GIC back then, and people would ask me, well, what are dividend stocks paying? And I'd say, you could get 5 to 6%. People wouldn't like that because they would say, but I can get 5% from a GIC. What I would explain is that this is not an apples to apples comparison. And I'll basically illustrate why that is. So with the GIC, the payment that you get, the interest payment, is what it is. It will remain the same regardless of what happens over the coming years until that fixed income matures, and then you have to renew it. And then you just get whatever the rate is, the prevailing rate of the day. So if, for example, you were to take on a 10-year bond or a longer term GIC for 5%, you can expect 5% over the term of that fixed income security. Now let's compare this with a dividend growth stock. So we're going to start at the same yield of 5%. But in this case, we're going to assume that the dividend stock is growing its dividend at a rate of 5% per year. So 5% initial yield, 5% dividend growth. This is a fairly standard mix. There are opportunities in the market that provide this mix of yield and growth, and other opportunities, an even more attractive mix. But there are many opportunities with these metrics. So as you go through the years, those dividends continue to increase. And what happens is that your yield, your effective yield that you're being paid on that initial investment, increases with it. So if we were to extrapolate this out 10 years, that fixed income security that originally paid you 5%, if it hasn't matured yet, is still just paying you 5% of your original investment. But the dividend growth stock, because it's been growing its dividend every year, is now paying you an effective yield of close to 8%. So that's a huge differential. And the difference, again, if it's a great company that's continuing to grow, it can continue to grow its dividend for 10, 20 years or more. And that's something for the grandkids in the future, potentially. So there are many examples of companies that we recommended through our income research in the past that have been absolutely outstanding with respect to growing their income distributions or dividends every year, and have since paid out far more in dividends than our original recommendation price. Are a few examples. One might be Brookfield Infrastructure that we recommended in 2011. We recommended the company at original purchase price of about $960 Canadian. It has paid out nearly $14 US in income distributions since that time. It's also increased its distribution by about 190%. So when we look at what is the current yield based on the original entry price, it's significant into the double digits at this point. Another would be Exchange Income. We recommended this company at just over $14 in 2010. It has paid about twice that in dividends since that time. It's continuing. The business is continuing to grow. They're continuing to increase their dividend. So they offer an attractive yield of about 4.5%. So you have already, or the original investors have already gotten paid twice their original investment back, and they continue to own a great company with an excellent yield that is continuing to grow. So these are a couple reasons why we think that people should consider dividends as a part of the portfolio. But of course, they shouldn't be all of your portfolio. We believe that the most prudent investment strategy is to build a portfolio that can perform relatively well in a wide range of different scenarios, exposing you to growth opportunities while also managing your risk. So Dividend growth stocks are a part of that. In many ways, they form the foundation of your portfolio, mitigating some of the risks and giving you stability, while also providing income and dividend growth and some capital appreciation. But then you have the opportunity to augment the return of your total portfolio by adding in other types of more exciting companies, like many of the profitable small caps that we cover in our small cap research. When you mix these together in the right proportion, you're really setting yourself up for success in a wide range of different scenarios.
Yeah, and that's the thing. Like, once all of a sudden you're getting like an effective yield of like 22% on Brookfield, even if the stock pulls back, or they're going to be having maybe a tougher year, it's tough to sell a stock when you're earning 22% every single year and still expecting that dividend to grow, over time. I wouldn't be personally selling it, if even though the next year was to look, a little bit tougher or whatnot. Again, if you're making that 22% every year.
Yeah, and I'll say it's not. I'm going to share my screen. It's not just in our income stock research that we love dividend growth stocks, but in our Canadian small cap growth stock services. If you look here, like this is just about 5 years ago, we reiterated our buy on Hammond Power Solutions. It traded at $6, around that range then. This is Hammond Power's dividend growth. Their dividend since 2020, 2021 to today has grown 223.5%. You can see the 5-year astonishing dividend growth rate of the company over that period. That has given them an effective yield. If you would have bought them at that time, they're paying out 18.3% just 5 years later. So that is the power of buying great dividend growth stocks. And of course, in this case, in terms of Hammond Power, the stock has went from $6 to over $110 today. And, from our original recommendations, up 20,000%. So, you have income growth stocks, and then some of the highest growth businesses. Like we reference Boyd all the time. Boyd has been a dividend growth stock as well. So people think dividend growth stocks, certainly like Brookfield Infrastructure isn't a stodgy old dividend stock, but they think of dividend stocks as, the BCEs of the world, or companies that just have a yield over time. Some of the best performing stocks in terms of share price as well, on the TSX over the past several decades, have been stocks that have grown their dividends over time. It's just a responsible way of management every quarter to know they have a payment that has to be met. They have to grow the business with the residual cash flow, and they have to grow that residual cash flow. If they grow that residual cash flow, they can grow the dividend. It's a good model, and it tends to lead to better management in businesses over the long term. So that's what we look for in all our areas, really, of business. And that's it, right? We're ending it. You guys got nothing. You're like, I got to go eat food. Let's get the hell out of here. Okay. Excellent. If you are watching this on YouTube, smash that subscribe button. If you're listening to this wherever you consume your podcast, rate and review us. As always, keep your questions coming in for our Your Stock, Our Take segments. We got to give away a mug. We got to mug somebody in the next couple of weeks. So we'll do that. And as always, I wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.